Welcome, everyone, to tonight's Sunday Macro Wrap-Up for Sunday, February 22nd. My name is Johnny Zerdy. This is Macro Optics. Got a lot to cover. A lot of stuff happened last week. This week is a little bit more quiet in terms of macro data releases, but we'll be covering a lot of that stuff anyway. Yeah, I mean, last week was quite the doozy. Lots of announcements from Washington, as well as we got some new confirming data of stagflation. And then towards the end of the week, we had sort of an escalation in the Middle East conflict, which could spark gold and other precious metals to continue higher. So there's a lot of developments going on right now, and then we'll see what type of carryover that happens this week. But for those who are joining the Sunday Macro Wrap-Up for the first time live on stream, the way that these work is that the first 30 minutes is streamed online for everyone, and then the second 30 minutes, it's an hour total, is actually offline for our Macro Optics members. If you would like to participate in that offline chat for the second half, where we discuss actionable ideas and get into the charts, you can just go to over to our website, macro-optics.com, and you can check out our Macrovision membership there. 7-day free trial. After that, $49 a month. You get basically all of the top ETF and stocks that we have, the top 10 stocks, as well as the top 14 index ETFs for those ranges and trends, as well as a couple of our sample actionable ideas. But you guys can check that out on there. But without further ado, we'll go ahead and get right into it here. So, yeah, last week the Supreme Court struck down all of Trump's tariffs, and he was pretty upset by that. And as a result, he announced that he's just going to do a across-the-board 15% tariff. And I'm not sure. I think he did it on some other type of executive order than the one that he did the previous Liberation Day tariffs on. So that was a major disruption in terms of the tariff narrative, right? That's really been the wild card factor for a lot of the markets. And so that was pretty interesting. The Supreme Court delivered a historic 6-3 ruling invalidating the president's unilateral Liberation Day tariffs, under the IEEPA. While this temporarily raised hopes for $160 billion in corporate refunds, the administration immediately retaliated by invoking Section 122 of the Trade Act of 1974 to impose a temporary 150-day 15% global tariff. So this is a little bit of a regulatory whiplash. We got to see how supply chains hold up with all this. But yeah, I mean, I think that it's just continuing this capital flow into things like materials and industrials. And so this is mainly just benefiting the things that we've already been long, right? Interestingly as well, we saw a number of, large fleet Air Force planes heading to the Middle East from, I think it was either Washington or one of those, Virginia or something like that. So we could see some potential uptick in some Middle East conflict. And of course, whenever that happens, people tend to flock to safe assets like gold, silver, that sort of thing, which we did see silver and silver miners were the best performers last week. So that's pretty interesting. We'll see how that carries out this week here. But then the real big thing that we got last week was the surprise of the GDP number. So all of the forecasts for the Q4 GDP of 2025 was 3%. And just a reminder, whenever they come out with these GDP prints, even though they're quarterly GDP numbers, they don't represent just the quarterly growth, right? It's the quarterly updated annual growth, right? So it's always annualized. And so, for example, when we get the Q1 GDP for 2026, that is projecting out the entire growth for the year of 2026, right? So it's an annualized projection. And so whenever we get the Q4 GDP numbers, that is the final number for the entire year. And we saw that in Q3 of 2025, there was an annualized estimate of 4.4%. Well, that completely reversed down to 1.4%. And I think even the estimate was around 3. So as you can see, it was a crazy whipsaw. I mean, in January or Q1 of 2025, I had negative 0.6%, and then Q3 plus 4.4, and then it ended up settling around 1.4. It might fluctuate a little bit because you do have two more estimates, one being the second estimate and the third one being the final estimate, which is the one that gets recorded as the official number. This was just the prelim, but typically it doesn't stray too far from that. So huge GDP miss, but it wasn't too surprising, right? We saw bond yields come down a lot over the past few weeks, and then Bitcoin has been a train wreck, which is usually growth and liquidity sensitive. So it's not too surprising that those things were front running this slowing GDP number, while at the same time we had the December core PCE prices index come in, which is the Fed's preferred inflation gauge. And this actually accelerated to 3%, which is a little bit higher than what the street was expecting there. And this is quite the acceleration. I mean, really, the last time that we were near this was in February of 2025. And this is obviously the opposite direction of what the Fed wants the inflation rate to go towards. And so now this is separate from CPI, right? So you have two really main inflation estimates. You have the PCE price index coming from the personal consumption expenditures, and then you have the consumer price index, right? Both are important, but typically the core PCE price index is what the Fed, or at least this current Fed, was looking at in order to judge policy. And obviously, this is going in the complete opposite direction of what they want it to. And so when you have growth slowing, but really remaining stagnant, and then you have inflation accelerating, what are you going to have the Fed do? What are they going to do? They're going to continue their pause, right? They aren't incentivized to cut rates if inflation is reaccelerating. And so that's happening at the same time where you have comments from a lot of, Fed members, FOMC members last week saying that the labor market, which really it's the Fed is always going back and forth. Well, right now they've been going back and forth over the last 3 years between labor market fears or inflation fears. When the Fed is worried about the labor market, well, the market's happy because they're pricing in rate cuts. When the Fed is more fearful about inflation, the market panics because now the Fed is, going to slow the pace of rate cuts, right? And so now with a lot of Fed members saying, look, we're very optimistic about the labor market. Temporary firms are doing very well. This usually boosts jobs with all the CapEx spending that's going on. And then also them saying if inflation starts to run away higher, then rate hikes would have to be on the table. And so a Fed board member hasn't said the word hike in quite some time. Now, I don't think that's going to happen, but it is interesting seeing this huge tone shift, which we also got in the Fed meeting minutes last week. And so he also mentioned, with the strong economy, the potential for inflation to worsen is there, but they're remaining optimistic, right? So again, this huge shift from the Fed and from labor market fears to now inflation fears, causing them to be, a little bit more hawkish. And so when we take a look at the target rate probabilities for the March 18th Fed print, we can see that at the current time, it's a 96% chance that they're going to remain pause. And so let's see if we're able to take a look at when they're likely to cut here. One second while this loads up. Oh, wow. Okay. So, yeah, the first cut is being priced in July now instead of June, and then the second in September, and then throughout no rate cuts from October 2026 to December of 2027. Wow, okay. So that's pretty interesting. So right now the market is pricing in two back-to-back rate cuts in July and September, and then that's it for quite some time, leaving the Fed fund neutral rate between 3 and 3.25. So that's still technically higher for longer if you're looking at the average interest rate or Fed funds rate over the past 15 years. And so, yeah, I mean, this is more of this new economy that we're in where we have higher than average inflation, higher than average interest rates. And at some point, these high rates will start to break some things. But just because that, might happen in the future doesn't mean that you want to just be short everything and in fear. A lot of these different headlines that come out are meant to just trigger an emotion inside of you. And so it's really good to make sure that you fade all those emotions and fall back on some type of math-based um, strategy that you might have for yourself. And if you don't, you can check out macro optics. But this is something where it's definitely going to be higher for longer after these next two rate cuts here. Which, if we continue to get a lot of this more stagflationary data, could be pushing it out further. So rate cuts are getting more and more on the back burner there. Um, Yeah, so Fed policymakers split over the next move on rate cuts. Lots of uncertainty there. New York Fed manufacturing continued to accelerate, although it has been accelerating at a lesser pace. Initial jobless claims continue lower, reinforcing the Fed not being as concerned, on the labor market there. And so we are going to continue to enter this higher for longer regime here. But I'm sure that'll change. We talk about this no landing, stop, go cycle that I keep referencing almost on every single video now. But it's just, really important to understand this. And, this has been going on since 2023, where, right now we're in the stop phase where we get a hawkish Fed, rate pause, stocks, chop sideways or drop. We get more of these hard landing fears. That ultimately lowers inflation expectations, where we start to see positive inflation numbers, and then the market goes, okay, inflation's coming back down. Maybe we can get a little bit more optimistic, and that's really where you see a large rebound or a large bounce from the market after being pessimistic for some time. Now, this cycle will end in some type of hard landing. Not sure when that's going to happen or in what fashion or magnitude, but the thing is to not try and predict when that will happen, because you're just going to miss out on continued gains if we end up going through this cycle once again, which a lot of people have been missing out over the past 3 years. But we're going to continue in this cycle. Don't underestimate the government on how much they're able to just print money and issue treasury bills. So we'll see what happens. We continue to see liquidity being more and more tightened, though. And as of right now, looking at the United States yield curve, this has been flattening, now on a 3-month trending performance. And specifically, it's been bull flattening, which is where the long end of the curve is falling faster than the short end of the curve. And this is coming from a bull steepening to a bull flattening, and this is on our team's thesis on the yield curve's phase signals. This is signal number 12. And we experienced something like this from 2010 through 2012, 2015, and late 2023. And it's typically characterized as after aggressive easing and steepening, long end yields roll over as growth disappoints, while short rates remain pinned. The curve flattens, market shifts from reflation to a stagnation outlook. Stocks can chop sideways. Usually, long term bonds rally, as well as gold or things that are store of value, whatever is perceived as that. So, confirming macro indicators, weak GDP, we saw that. We're not getting lower CPI just yet. Fed is definitely holding. ISMs are softening on the services side. And so, yeah, the market is having doubts right now. Now, from a bull flattening, you can get any type of characteristic. Usually it's another steepening phase. So, if we go back into something more optimistic after this, little brief period of pessimism. And when I say pessimism, I mean just the things that, is on TV all the time, which is stocks, mainly the Mag 7 as well as Bitcoin, right? The things that, we've been talking about on this channel, industrials, materials, energy, staples, all those things have been in crazy bullish trends over the past several weeks. Just take a look at something like XLP, which had a little bit of a buying opportunity last week. Energy, right? There's lots of sectors that are in bullish trend, but really it's tech that remains sluggish, right? Also, in looking at something like Qs, same thing, really. So that's really the area that we're in right now. And so we want to make sure that we are holding assets that continue their bullish trend and not just trying to time bottoms on a lot of these different tech stocks. I know that a lot of people like to do that, but that's not giving you the highest chance of winning in the long term or even in the medium term. But heading into this week, though, actually, let's take a look at some of the heat maps. So we did see a little bit of a bounce from the S&P 500 Qs and a lot of the different things that were down a lot. It provided a really good selling opportunity. So if you were bag holding any of this stuff, last week was a great opportunity to just clear out some of those losers and then take advantage of some winners that were having a discount, such as consumer staples. So one interesting thing though is that Nvidia ended up reclaiming bullish trend. Nvidia has earnings on Wednesday of this week. So this is the largest stock in the entire market. Got to remember that. What time is that on Wednesday? I think it's after hours. Yeah. And then we have Lowe's in the morning on Wednesday and then Home Depot on Tuesday morning. So Home Depot and Lowe's, pretty important, right? It's home builders. It's kind of a staple of, the entire economy, right? I mean, if Home Depot and Lowe's continue to accelerate, then that's typically a good indicator for the general economy, right? The aggregate. But so we have Home Depot and Lowe's, both of which are in a bullish trend. Lowe's is in a little bit more of a favorable trend there, but we have both of those this week, and that's really it. We have a couple other ones too: Dell, Monster, Intuit, but it's really Nvidia on Wednesday, Lowe's on Wednesday morning, and Home Depot on Tuesday morning of this week. And then when taking a look at the macro calendar for this week, really it's a quiet macro week. We do have the State of the Union address, which is on Tuesday night. That'll be, I think that's President Trump's first State of the Union address as his second term. So I'm sure it'll be a lot of just hoorah, hoorah, look at all the stuff we've done. Yeah, I'm not sure how much market impact that will have because it's more of like a pep rally. So it's something to watch, I guess. But I probably personally won't be watching that. Probably just get the highlights in the morning. And then, yeah, I mean, we get producer prices on Friday, Chicago PMI, nothing really too crazy here. So, as much as my team and I don't like to focus on headlines, we really need to see what happens with, this whole tariff thing, as well as the conflict in the Middle East. If you don't want to pay attention to the headlines, or if you want to stay ahead of that, I would recommend taking a look at the price of oil, which oil has been in a huge bullish trend recently. And typically, my team and I look at oil as an early indicator of aggregate inflation. So CPI, right? Energy is a very large component of headline CPI. And the price of oil typically front runs the CPI print by about 6 weeks, right? Give or take. Meaning that if since the price of oil has been going up pretty much since the end of February or the end of January until now, right? So that's like an entire month's worth of acceleration in oil prices. That doesn't get reported in the February CPI, or if that doesn't get published until the February CPI, which doesn't get reported until the March CPI. So this move that we saw in oil prices, this acceleration, most likely won't show up until the report that comes out, all the way in March, right? Or I'm sorry, the acceleration in February won't get reported until April. So, yeah, we'll see what happens with this acceleration in oil prices, but it typically front runs inflation. We'll see what happens there. But that's pretty much all I'm seeing here in terms of the macro updates. The best performers last week: silver miners. Also got a little bit of South Korea, EWI. So those were some of the best ones from last week. Some of the worst performers: Japan, EWJ, which remains in bullish trend as well. And then XLP, consumer staples, which was providing a buying opportunity. Was that near the low of the trading range? Not really, but below that midpoint. So probably a good time to add some there. What else? TLT had a little bit of a drop. Bonds remain in bullish trend. So you had some opportunities there. But that's really all I was seeing here. What else? I think I covered most of it here. Okay. All right. So from here, we're actually going to turn offline to our Macro Optics members. We have some people here on Zoom. Hope everyone is having a fantastic Sunday evening wherever you are. But let's go ahead and say goodbye to TikTok, Instagram, and YouTube. Hope you have a fantastic rest of your Sunday evening. And hopefully we'll see you offline in the community there. Have a great one, everyone. Bye.